So Friday we had a picture perfect bullish intermediate confirmation signal. Today we bounce. How long is that going to last? That's what I'm going to break down in tonight's video. I'm also going to look at a stock that's been volatile within a range, and how can we trade that with the expectations that things will be a lot less volatile for the stock. So let's go ahead and get started. Today is Monday, May the 21st, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. Thank you very much for watching tonight. Welcome to those of you watching for the first time. Glad you found us. Keep coming back day after day. Subscribe to our YouTube channel by mousing over the logo in the bottom right corner of this video and then clicking on the red subscribe button that pops out. Also, like today's video by clicking on that thumbs up icon right down below the video. One click tells me that you got something out of this video today and you want me to do it again tomorrow. Really easy way to give me feedback there. Comment on anything that stands out to you. What did you get out of tonight's video? I want to hear what you got out of it by scrolling down to the very bottom. Finally, join the Market Outlook daily email list with a link that's in the video description below. Follow me on Twitter for more content like this throughout the day, throughout the week. You'll see my handle up on the screen at DavidSettle42. Like and retweet tonight's Market Outlook tweet, always pinned to the top of my timeline. Join the Market Outlook community on Facebook. There's the address at the top right left corner of your screen as well. There's also a link in the video description that will take you there. All right, let's take a look at the market forecast indicator on the S&P 500, and you can see we're in the green mode here, which means we have a strong bullish posture. You know, we expect this to be with maybe some light pink shading like this here. We expect this to last, 1 to 3 months. Probably more towards the 2 to 3 months because market sentiment's still below 50. It's actually dropping a little bit. I mean, it's just kind of going up and down here. As we are rising, we are above a rising moving average. That's why it's colored green. You can see the momentum line and the near-term line both jumped. We jumped up off of Friday's bullish intermediate confirmation signal. In fact, kind of like the best type of bullish intermediate confirmation signal, where you have the intermediate posture up above, or strongly bullish, which means it's above 80. So I mean, you can have a bullish intermediate confirmation signal anytime the intermediate posture is bullish. So it could be rising here from below 20, and technically by definition be called a bullish intermediate confirmation signal if your momentum line spikes or drops below 20. Here you would think, but the intermediate line had dropped down on that day. But technically, you know, if the intermediate line had not dropped down that day where my cursor is, then that could by definition be called. But the best ones are when you have a strong bullish posture, which means not only is the intermediate line rising, but it's above 80 and it's entrenched above 80. And then the next layer on top of that is having the near-term line below 50. So, because then that opens up the possibility of a new 7 to 12 day in a near-term run. That, you know, we had that run here. It ended up being, let's see here, it was this near-term line there was at 35. I'm looking over on the left. So that one got the 71. So 1, 2, 3, 4, 5, 6, 7. And then that one, it got to 46. So 7 days. That was a 7-day bullish intermediate run. Now we've had a little bit of a pullback, and now the expectation is that we get a new 7 to 12 day intermediate run, especially considering that we're kicking it off with that combination of a bullish intermediate confirmation. And of course, anything can happen. It doesn't have to be that way. But that's expectations based on the pattern that we see there. Take a look at the Dow Jones Industrial Average, and you can see its near-term lines jumping up a little bit more. And in fact, unlike the S&P 500, which is still below 50 today, the Dow Jones did cross up and close up above both these highs from April and last week in May, closing above those levels. You can see we had the high there at 24,994, so getting above 25,000, significant for the Dow Jones. See, the S&P 500, yeah, we are above that April high, but we weren't able to close up above last week's high. So a little different there for the Dow. So a better short-term picture. Again, basically its 7 to 12 day run has started today. And then you look at the NASDAQ composite, which is not as bullish. You can see its near-term line is the weakest out of all of these. Had that same bullish intermediate confirmation signal, bounced up today at least, but still not quite as bullish as that short-term sentiment, still lagging there behind the 50th percentile. Strong bullish posture, and then looking at the Russell 2000, which is the most bullish out of all these indexes, and this is, I mean, look at that run that's really taking off there. You can see its posture is strongly below 95th percentile in the intermediate posture. Near-term line up above 80 now for 3 straight days. So you can't have, I mean, that can't be more bullish than what we see on the small cap index right now. So bullish posture across the board. NASDAQ not as bullish in the short term as the Russell 2000 and then the Dow. So you kind of got, you know, bifurcated. The Dow, which is like the bluest chips of large cap stocks, and then the small cap, the Russell 2000 small cap index on the other end. Both those opposite ends are doing really, really well. The ones in the middle, especially those tech-oriented companies, not doing as well. Still bullish. The posture is still bullish, but not as much relative performance compared to these other asset classes within the equity universe. All right, a quick reminder here, if you're watching the blog through the Market Scholars website, here on the embedded YouTube video, that you've got all the YouTube features here to be able to use. But also remember, too, that you can like the tweet, the Market Outlook tweet tonight here on that same page while you're watching, as well as like the Facebook post, and you can click on that green button here on the blog. So I did notice that we were getting over 200 likes while I was away, with Brandon doing the video. So again, it's really, really easy, and clicking those 3 things tells me, number one, that you want me to keep doing these videos day after day. It's a really easy way to give me feedback. The other reason that benefits you is it tells Twitter and Facebook to keep pushing you our stuff as we put more stuff out there on these platforms, and it benefits us because it gets all this stuff out to more of our followers. Not all of the people who follow our accounts will see these based on the algorithms these social media platforms use. So we really appreciate those who like and share these posts, and we try to make it as easy as possible for you to do that. Heading back over to the charts, you can see on the long-term chart, see how the MACD is starting to rise, which is the gap between the 50 and the 200-day moving averages. We've been above the 50 now for a couple weeks. I wouldn't be surprised if we spend about another 3 or 4 weeks or so up above that line. But we are in the mode of where we're going to get more volatility, like here, because we are declining as I've got that line drawn with that anomaly of a peak right there. But we're kind of going up and down, so we'll see how that continues. But I think we've got a few weeks that will be above this based on what I've seen in the past. You can see that's the S&P 500. The Dow looks very similar. There's your NASDAQ composite also looking very similar. And then finally your Russell 2000, which is, all-time highs every day, or every week a new closing all-time high. So very, very strong. And in fact, if you take a look at let's get some context here. You take a look at the MACD, it's rising. It's not back up to these old peaks. That old peak here wasn't nearly as extreme as it was in the S&P 500. If you recall, the S&P 500 was really, really extreme, right? So not nearly as extreme there, but still kind of in that mode of working its way towards zero while going up and down, and more volatility in the ups and downs compared to the S&P, because it is a small cap index, so it'll have more volatility. If we take a look at the 3 green arrow charts, let me pull those up here. You can see we got 3 green arrows in the S&P 500. We're above a rising moving average. The Dow looks very similar. The NASDAQ composite, and again, 3 green arrows. We are losing momentum, but the buyers are still well in control according to the stochastics indicators, still easily up above. And if you take a look at the 3 green arrows on a 3-line basis, you can see how we tested last week the 8-day moving average and bounced up above that. So very, very positive. You can see how when you start a bullish trend, you'll test that 8-day moving average for a while before that gap between the two lines will shrink, which is what the blue line measures. The blue line measures the gap between the 8 and the 17-day moving averages. So as that gap starts to shrink, and which means the blue line's coming down towards zero, then you'll start getting some tests of the 17-day moving average. And right now we're still kind of in that rising mode. It's still above its moving average. Once it gets below its moving average and starts to, grind its way lower, then you'll see some testing of that 17-day moving average, but still being above the 30. So it means you can still be bullish for a while before the lines converge. And then, like I said over here, we should have diverged to the downside here, but we had that fluffy move that was quickly, quickly erased and corrected at the beginning of this year. So if I were to now here, let me actually go back to that market forecast chart here really quick. You can see the range today right here was well below average, less than half of what the ATR is right now on the S&P 500. Not as small on the Dow Jones or on the Russell or the NASDAQ here, but on the S&P it was really, really small range compared to normal. So you get regardless, it was a small range day today. If you take a look at the 4-week chart, you can see we are pushing up. We didn't get new highs all last week, and we haven't really today either. But we got close to the 4-week high point. And remember, we're trading. The more we stay up here on the right-hand side of the chart, and the low is over here on the left-hand side of the chart, that's bullish. And so we're easily above the midpoint of the 4-week range. I mean, you can see where there's going to be some pretty decent support right about 268-ish, as well as that midpoint. And of course, that midpoint's going to change as we move this up. But obviously, we're a lot closer to pushing the upper band of this 4-week range higher than we are pushing the lower band lower. So very bullish perspective from that regard. Of course, as I showed you before, the range was really small. Volume continues to be below average here. So when you look at that, chart, you see how the volume continues to decline, the average volume, as well as the ATR, which measures the ATR relative to the current price. So both of these lines, and if I were to zoom out for some perspective on that, both of these lines continuing to fall towards their 52-week averages, which is bullish. When they're falling down, they're bullish. We take a look at the VIX chart itself. Let's take a look at this one first. You can see that we're kind of grinding. Like I said, it's not going to be easy for it to get below 12.5, and it hasn't. We're still at 13, and any bounce up in volatility is kind of hitting that peak around 15. And so we're kind of stuck in that range. And of course, looking at it relative to VXV, you can see we're in the bullish area, but we're at the top end of the bullish area. So we're not as bullish as we can be. That's the sweet spot says 85%. And of course, getting down here would be more bullish. So we're not quite as bullish, but I think the reason why is it's going to have a hard time getting below 12.5. We've entered a new period of higher volatility, where instead of dropping down below 10 like it did last year, where it was insanely low volatility, our low end is 12.5. And just for some perspective on that one, before last year, let me go back further. Before last year, you can see the low end was about 12.5. Then 2017 came and we traded below 12.5 for quite a while. So that was a period of below average volatility. There's the norm, getting below, using 12.5 as the low point, which is kind of where we're at right now. So, eventually we'll probably get, after an intermediate run, we'll get some higher volatility, similar to what we got over here. After a few months, after this spike, we came down a little bit, and then we had a bigger spike again. That's coming down the line. I venture to guess something like that, like we saw in the beginning of 2016, is coming down the line. Now, those are two bottoms below the 200-day moving average, ended up being kind of equal lows. I don't think we'll get another low point on the stock market, at least, as far down as we've seen this year so far, because I think we're going to start grinding higher throughout the rest of this year. But there's going to be a pullback at some point, more of a normal pullback, because this was all very abnormal last year. So we're going to get a move like that. I still think we're probably a few weeks away from something like that even starting, though. So to summarize, the market posture is bullish. We've had a near-term breather, so to speak, over the last few days, over the last week. And today, starting off of this bullish intermediate confirmation signal we had on Friday, starting to bounce today that may last for a week or two. And push up off of what would be a higher near-term low point to potentially a new higher near-term high point. And continuing this intermediate trend that we're on, this bullish intermediate trend that could last, again, 2 to 3 months, that we're probably a few weeks or 2 weeks into right now. So we're moving ahead, we're moving upwards, we're moving onwards. We're not moving at the same pace that we've seen before, but volatility is falling, volumes are falling, ranges are falling. Those are all typically bullish. They're painfully slow, but the direction of the market's typically bullish in that type of environment. So tell me what you think. With this poll that's popping out in the top right corner of your screen, do you agree with this market posture? Do you disagree? If you disagree, let me know, because the market's made up with everybody. So let me know down in the comments what you're seeing that tells you otherwise. Would love to see or hear what else is out there. All right, now let's talk about what's driving the price action. Of course, today's big mover to the outlier was crude oil. Crude oil benefiting from the news over the weekend of this trade war not being as big of an issue anymore. And so it really has taken off. You can see dollar was relatively strong early on in the day, but then pulled back. And as a result, gold was up. You can see long-term bonds were up today, on a day where small cap stocks were up a little bit, large cap stocks down a smidge. And again, this is from the open. It does not include gaps, right? So this is, when I say up or down a little bit, it's from the open. Of course, stocks gapped up today, but we just don't have the ability on this chart to show to move that starting point at the end of a day instead of the beginning of a day is what we have so far. So from the open, stocks were able to maintain that strength, the overnight strength, and were relatively flat. You can see emerging markets, they were also down, as well as agricultural commodities down. Those are your weakest ones to the downside. But again, China being in that emerging market space. Interesting that China had an update today with this intermediate line showing a bearish posture. That's why you have the pink here. Japan also showing pink. But some of these other emerging markets, India, it's got its intermediate posture is strongly bearish and well below the moving average, showing a cluster today. Mexico showing day-to-day clusters, also with an intermediate posture below 20. Brazil, intermediate posture below 20. And it's obviously got a bearish posture too. So those are your really weak areas right now within that emerging market space, which has been lagging. You can see South Africa also has that link to gold prices, but again, also below 20 in the intermediate posture, so strongly bearish, and showing an oversold cluster, excuse me. So those are whereas Russia here and China, your kind of bigger countries from that bigger countries, you can see the intermediate line is rising up above 60 for Russia, so showing some relative strength. In China as a higher position, though, it is falling, but still above a rising moving average. You can see that yellow line on Russia will turn green tomorrow, as it is now rising above a moving average. So coming off the cluster it had back in April, it's been steadily gaining some ground. So you can see where the weakness in the emerging market space is, and you can also see where the developed markets are doing. You can see Germany is pulling back a little bit, but United Kingdom and Canada are both above 90. Israel above 90 as well. Australia, linked to commodity prices, also doing well, up above 80 and rising. So you have those are your strong bullish postures on an international market perspective. All your risk on relationships are still showing very strong stocks outpacing gold. You can see equal weighting is outpacing over the last week or so, the market cap weighted, which means those mid cap stocks are showing some relative strength. Small cap stocks are pulling back today, but still, upward trend. Discretionary is showing an upward trend against staples still, stocks versus bonds, commodities versus bonds, oil versus gold. The only one that's really not that risk-on relationship is the emerging markets, still lagging behind and struggling versus the developed markets. Growth pulling up, and you can see I've shown you this chart before. This long relationship where stocks has just been killing commodities for years and years and years. Well, that's starting to pull back, and I think that relationship right there is going to drive a lot of what's going to happen over the stock market, and not just the U.S. stock market, but global stock markets over the next year or two. Is the potential for commodities to really outpace stocks. If I were to go back and see how far this will let me go back, you can see, last time we had significant declines in this relationship of SPY versus DBC was when the stock market peaked in 2007, 2008, and I see something like that here, where you'll get some opportunities for commodities to really start to outpace, and that's usually a sign that we are in the very late mature stages of a long-term bullish cycle that does not end in a day, right? It doesn't, these long-term bull markets do not end in a day. They end over a long period of time, and it can be painstakingly slow. So that's why don't get caught up in the uproar about, oh, we're so overbought and things are going to crash. And no, it doesn't happen like that. It takes a long time to get into the mode where fall 2008 happened and stocks tanked and fell off a cliff, right? The market peaked in the fall 2007, and we had a year of declines. But we also had, a year and a half of commodity prices spiking to higher prices, giving us a sign that we are in a mature bull market at that point in time. We are just starting that right now. All right, if you take a look at the sectors and how they're performing, energy, crude oil performing as it's been doing this over the last 2 weeks, with energy performing as well as it has been, you can see that it's outperformance, along with industrials up here at the top and materials. So there's your typical, kind of weak dollar move, where those commodity prices and inflation rises, you expect those to continue to outpace, and industrials kind of the third leg of that. Industrials is the third leg of most bull markets, with discretionary technology usually outpacing during strong dollar moves. Over longer term strong dollar moves, you can see they're lagging behind the market over the last 2 weeks. Still up, still showing, some gains, whereas, your interest rate sensitive areas, real estate, utilities, staples, still lagging behind. Those two, after having a pretty decent run, relatively weak, and you can see they did okay today. And again, just looking at was unable to look at the gap. So disregarding the gaps this morning, and you can from the open today, real estate finally bounced back up, and so did utilities. So a little bit of a pullback in some of these areas that have been performing. Not so much energy. Energy lagged early. A little bit of a bounce up late. See, there's the energy early and bouncing up late. Technology still lagging behind, but there's materials also pulling back, with utilities and telecom and real estate, those interest rate sensitive areas outpacing throughout the rest of the day. Not your typical bullish setup when you're talking about the beginning of a new bullish near-term run. You would prefer to see energy, materials, industrials up here, not these interest rate sensitive areas, because they're also considered safe haven areas. They can go up. They usually lag behind the broad market during bullish moves, and that can definitely be the case. You can see obviously this is just a 1-day phenomenon, because again, over the past 2 weeks they're the biggest losers. So not surprising that they'll show some relative performance, as usually what happens after a 2-week period of outperformance or underperformance, things start to pull back towards the middle. If I zoom out to the 4-week chart, I mean, energy has really been the best performer. It's continuing to really show some relative strength. Technology, you can see why it's pulling back a little bit. It was a strong performer. Real estate and utilities have been doing well, but now look at how utilities reverses to the absolute worst, along with staples over the past 4 weeks. So kind of back to that safe haven status. When you're in strong bullish posture, those will lag. Those, in fact, in this case, not only lagging, but falling, showing some negative returns there. If we take a look now at the 12 grid chart here, and this kind of show where the strength is. Remember, above 80 is a bullish posture. You have financials, technology, energy, materials, discretionary, all above 80 with rising moving averages or it's stuck into that area. You can see there's also a couple others that are getting close. Healthcare and industrials. Industrials is rising towards 80. Healthcare is pulling back. So it's showing a weak bearish posture right now with it coming back. And you can see energy showing some overbought clusters here recently. And same thing with real estate. And you can see the weakness that we've had in utilities really falling off a cliff after some relative performance. And there's telecom. So real estate and telecom kind of bouncing up a little bit, but off of some, really bad week last week for both utilities and real estate, with telecom relatively flat. And staples, as I mentioned before, basing. It's been so bearish for so long. It's like with utilities, its intermediate posture is below 20, so is staples. So these are the only two sectors right now showing strong bearish postures and below falling moving averages. Can't really be more bearish than that for those two areas. Eventually they will rotate into favor. Now's not the time for that yet. So for our trade idea of the day, I want to take a look at a stock in that industrials area that's been kind of bouncing back and forth. You can see on the chart here, Delta Airlines, showing some relative strength today. Showing 3 green arrows, getting above its moving average. MACD and Stochastic showing green arrows there. When you take a look at the Bollinger Bands, it's the Bollinger Bands have been tightening. It's kind of we're kind of in this mode where we're not really breaking up above. It's getting above the middle moving average, so it's a little bit of a bullish bias after being below it for some time, but not really getting outside of either band, which is what would get it either below 0 or above 100. So not really in a breakout mode. You can see there's a lot of volume stuck in this area, and so of course when you see a stock like this that's in a falling volatility mode, that's stuck in the range with a lot of volume stuck in this range, and we can play both sides of the trade. And you can see I've got set up here to sell the 57 call and sell the 51 call. Sell the 57 call, which would be right about in that area, and then sell the 51 put, which is right down here in that area. So you can see it pretty much brackets that period of volume, which keeps this stock kind of stuck in this area. Doesn't mean it can't break out, because anything can happen. But while we're stuck, here's an opportunity to try to take advantage and buying the 60 call and buying the 48 put, just in case it does break out. That would limit my downside to $220 with the potential of getting $80 return, or minus the commissions in this particular account, getting you a $77 return for $220. So not a bad return. When you take a look at the odds, about 60% odds of success, and throwing those slices onto the chart. So set those slices to break even, and then throwing those slices onto the charts. You can see there's where my break evens are, above these highs, minus that little breakout that didn't last long. And then below all these lows over here too, over the past so many options expiration cycle. And you can see by the June options expiration cycle, now this is, this goes on to June 29th. So weekly, because the July is just so far away. So it's got 39 days out. So it goes a little bit further out to July 29th, or June 29th. We're talking about right there. So you can see where the purple lines are. Those are the odds. That's a 1 standard deviation bell curve of where the stock can trade within that 1 standard deviation between now and the 29th when this options will expire. So it allows us to play kind of both sides, figuring that it will kind of stay mired in this area, especially with we have this bullish move right now in the broad market as a whole, and it's got some room to move to the upside. But you also got rising crude oil prices here that are having an impact that can have an impact, especially on a sector like this, considering that's one of its bigger expenses. Here we go. The crude oil just continues to move its way up past $70, and is this is the move. This is the kind of move you start to see in those late stage cycles, and will have an impact on stocks like Delta Airlines, which will benefit from the growing economy, but that will be hampered by the sharp rise in input costs. And with volatility as low as it is, and you take a look at its options over here, its options are really, really cheap right now. Its historical volatility, the past volatility has been lower than average, and it's expected to be, and that's what implied volatility measures, it's expected to be even lower. So we've been kind of falling, and you can see that it's really kind of grinding away in this area. Opens up that ability to trade, and you can see I'm getting it for a $3 wide credit. I'm getting here about an $80 return, for $80 out of 220. Above that 30% area, which is typically what you look for when you're trying to sell premium. So as always, love to hear what you have to say about today's trade idea on Delta Airlines, as well as today's market posture. So with the link that just popped out in the top right corner there to take you to the forum, Market Outlook forum on MarketScholars.com, go there. You can create a new topic. You can reply to other people's topics. Let me know what you think about tonight's video. As always, appreciate you listening to the video. Have a great evening, everybody. Remember to subscribe, like, and comment down below on the YouTube channel. You can do the same 3 things on MarketScholars.com as well. You can subscribe to our site there. You can like the video down below like I showed you before, and you can comment on the blog post too. So have a great evening. We'll be back on tomorrow. Brandon will be back on tomorrow, and then I'll be back on Wednesday. We'll see you then.